Question number 2, and this comes a lot with people getting into debt. And there's a lot of ways in which you can get into debt, and there's a lot of ways in which you can get out of debt. But I've had this question come up before where people said, hey, I've got a lot of credit card debt, or I've got XYZ debt. Should I take a loan from my TSP or even a hardship withdrawal from my TSP to pay off debt? Now, there's a lot in there. So I'm going to, again, speak in general. Depends on the type of debt, depends on the situation. Now, normally, I'm going to go to the second part of this question. I will not advise normally to take a hardship withdrawal. A hardship withdrawal means you're not eligible to take an in-service withdrawal because you're not yet age 59 and a half, and you want to withdraw money, not borrow money like a loan. What a loan means, right, is borrowing money. A withdrawal, I'm taking the money. You don't have to pay it back. But if you take a hardship withdrawal, there's a lot of documentation that needs to be provided. You have to show that you're either in a negative monthly cash flow situation, that you've had casualty losses, medical bills, legal fees, whatever it might be that puts you in this hardship, and you qualify for it. Now, there is a penalty involved with it, 2 kind of penalties. Number 1, you're going to pay taxes on it. That's not the penalty because it's a withdrawal of your TSP. But the first penalty is the IRS penalty, 10% for being under the age of 59 and a half. And then 2 is that TSP is not going to allow you to contribute back into your account for a period of time because you've taken this hardship withdrawal. So not something I normally recommend. If you're in an absolute dire situation and there's no other way, maybe, but the loan in these 2 options could be a better way to go. Now, why is that? The loan is borrowing money from TSP and then paying it back with interest. So you're paying yourself back with interest. Now, what is the interest rate on a TSP loan? It is generally the same percentage that is being paid out by the G fund. Now, the G fund typically pays out a pretty low percentage as far as interest earned on an annual basis. So the loan rate could be lower than what you're paying in whatever debt that you've accumulated, especially if it's credit card, and it can be upwards of 25-30% interest, 29.99% I've seen that you could be paying, and that could snowball and compound on itself and become a huge problem. So if people are thinking, well, I'm taking out a loan to pay off a loan or taking out a loan to pay off debt. Yes, it's not an easy fix. It's not a, the simplest thing ever because you are still going to be paying some interest. The best thing is to not get into debt in the first place. But if you are, perhaps this is a thing that you can utilize because the interest that you pay on the TSP loan could be cheaper than the interest that you're paying on the debt that you've accumulated. Now, the bigger part of this is just not to go back into debt. If you do that, this is not a get out of jail free card. It's not, oh, I've done this once and now I can accumulate all this debt again and I can go back into debt because I can always keep pulling from my TSP. No, I don't want you to do that because your TSP is your retirement nest egg. Okay. Now, understand it's borrowing. You're not withdrawing money out of your TSP, but that loan does have to be paid back. And if you retire with an active loan, then you can either take a taxable distribution or have to pay back that entire loan. So just understand, the loan is an option to get you out of a tough situation. It's not an end all be all. The biggest thing is, from a financial planning standpoint is let's not get into crazy debt to begin with. But if you're already there, and unfortunately, there's a lot of folks that I talk to that are, this is an option, not the end result or not the only result or the only solution to the problem, but it is a potential option if it's going to save you interest over time. Now, when you make repayments back, it's going to come normally as payroll deduction. It's going to be taken right out of your paycheck, and you've got to pay back a general loan within a 5-year period. So you can make automatic payments. You can pay back your TSP loan. Let's use this though as a last option. Let's try to get out of debt the old-fashioned way. Without having to take another loan from your TSP. If you can pay it back over time, you can get that balance down properly. That's something that we can discuss. If you've got a lot of debt, you want to figure out a way to get rid of it. Let's sit down. Let's go over it. Let's map out a plan for you. Thank you for watching the Federal Retirement Show. If you like this clip, make sure you subscribe, get notified whenever we have new content. We look forward to seeing you each and every week on the Federal Retirement Show.